Hi everyone, welcome back to the channel. As a financial planner that owns rental real estate, I get asked if real estate investment trusts are a good stand-in for directly held real estate. Now that's a great question because REITs and rental properties are both real estate investments, but they couldn't be more different when it comes to things like control, effort, risk, and returns. In this video, I'll break down exactly what a REIT is, how it compares to owning rental property, and which strategy may be a better fit depending on your goals. We'll also look at historical returns, including how leverage changes the equation for rental real estate. By the end, you'll know exactly where your next real estate dollar should probably go and why the answer isn't the same for everyone. So first up, what is a REIT? REIT stands for Real Estate Investment Trust. It's basically a stock that's backed by real estate. You buy shares of a REIT in your brokerage account, and the REIT invests in things like apartment complexes, office buildings, strip malls, or there's even a REIT that focuses on buying United States post office buildings. At least 75% of the REIT's assets need to be invested in real estate in order to qualify as a REIT. With a real estate investment trust, you don't have to manage tenants, you don't have to deal with repairs, and you also don't need to know the first thing about plumbing. In return, you get paid dividends, usually monthly or quarterly, and your shares can go up in value over time. Now, there's one thing to note about these dividends. Dividends are typically taxed at 0, 15, or 20%, but REIT dividends are taxed at your ordinary income tax rate, which can be as high as 37%. Although you may be able to deduct up to 20% of your REIT dividends on your tax return for some savings there. Now, there are a few types of REITs. There are equity REITs, which own properties, mortgage REITs, which invest in real estate debt, and hybrid REITs, which do a bit of both. And finally, REITs are tied to the stock market, so they can be more volatile than real estate, meaning they move around a lot in price, but they're much faster to buy and sell. As an example, Vanguard's REIT ETF was down over 30% in the span of a month during COVID, while rentals moved with the local housing market. And finally, REITs also offer built-in diversification. One REIT might own hundreds of properties. With rentals, most people only own a few. So sounds great, right? But let's flip the coin. What about owning rental property yourself? When you own a rental, you're the boss. You pick the property and you manage or hire someone to manage it. You collect the rent and you handle the repairs. You also will take on all the risk, but here's the upside. You will also get some pretty great tax benefits when owning a rental that you don't get with a REIT, like the potential for most of your rental income being tax-free and strategies such as accelerated depreciation and 1031 exchanges. Plus, you're in full control of the asset. But that control comes with much more effort than a REIT. I recently had to replace an AC unit for $7,000. Property taxes also go up and unexpected repairs do happen. On top of that, it can take months of actively searching to find a rental that's a good deal. Okay, so now for the big question. Which one can make more money? Let's look at historical returns. According to data from NAREIT, publicly traded equity REITs have delivered average annual returns of around 10.5% over the past 15 years, including both dividends and price appreciation. Those dividend yields alone typically range from 4 to 6%, meaning you're getting paid while you hold. Now compare that to residential rental real estate. Unleveraged rental properties, meaning no mortgage, have historically returned about 7% per year, according to a Federal Reserve study, which I have linked down below in the description. This includes rent and appreciation. Now, it's important to note that REITs typically use leverage to buy real estate. So when you buy a REIT, even if you aren't borrowing money to buy shares in it, the underlying business is usually using debt to buy the properties. But here's where things get interesting. When you use a mortgage on a rental, returns can jump up from 7%. One study from Arrive.com, I also have linked in the description, analyzed real-world rental homes and found average annual returns around 11.7% over the span of 10 years, which they came to after factoring in leverage, buying and selling costs, and a 35% down payment. So historically, if REITs have returned 10.5% on an annualized basis, while rentals have returned 11.7%, then you might be thinking 1.2% doesn't seem like a big difference. But over the span of 30 years, this difference can amount to over $750,000 in additional gains on an investment of $100,000. So yes, rental real estate can outperform REITs if you use leverage well. But leverage is a double-edged sword. If tenants don't pay or major unexpected expenses pop up, you could lose more than just your cash flow. You could lose the entire property. So what should you choose? If you want a completely hands-off investment with high liquidity and built-in diversification, then REITs REITs can be your best friend. If you want control and you're okay with being more involved for potentially higher returns, rental real estate can be a more powerful wealth building tool. But here's the truth most people miss. You don't have to choose just one. Many successful investors use both: REITs for steady passive income and rental properties for long-term growth and control. It's about using the right tool for the right job. So now the big question, which one do you prefer? Drop a comment below: REITs, rentals, or both. And don't forget to subscribe for more financial planning for real estate content. Thanks for watching, and I'll see you next time.